key to getting started with funding is finding groups that invest in companies like yours. I think in my early days as a founder, because I'm a first-time founder, I wasted a lot of energy talking to venture capitalists that weren't a fit for my company. Either they were investing in business to consumer applications and we're business to business, or they were investing in AI and we don't have AI, right? And so really doing your due diligence and making sure you're matching with like-minded venture capitalists who really invest in businesses like yours is a way to get started. The other key to getting started is to make sure you have revenue. Revenue is the key to everything. If you have some early pilot customers, the sooner you get to revenue, the easier capital raising will be.
So when we think about bootstrapping versus maybe a more VC-minded and hyper-growth oriented business, we looked at a lot of the opportunity that exists within our total addressable market, what our ACV is, what our client profiles look like. There's a lot of opportunity that sits as you go up market, especially into the enterprise, but you have to think about a lot more ongoing OpEx costs and build costs. You have to think about integrations. You have to think more about security. So there's a lot of opportunity that comes as you move up market, but you need the money to make that dream a reality. So when you think about bootstrapping versus a hyper growth round, I think a lot of it just comes to looking at that trajectory and saying, hey, where will we be if we remain on the current trajectory bootstrapping? And if we get these funds, how will we put them to work? Because once you have the money, people tend to spend it. So it's a really unique challenge that a lot of founders find themselves in, is it's responsible growth and knowing what a dollar in equals when you think about the dollars that are going to come out of that.
Yeah, there's definitely an ebb and flow to bootstrapping versus getting funding, and it's really there's a number of factors that go into that, including market conditions and just timing, and in terms of our revenue growth and the signals that we're putting on the market that are going to help us attract investors. Right? Sometimes we just got to keep our heads down and we got to focus on building the business. And then other times, the business is doing extremely well and the market conditions are great. Then we have to go out and raise some capital.
Bringing on new external funding was event-driven at Panacea Financial. So initially, it was finding that seed, that really seed to get us launched and to get us live. Our follow-on rounds have been around recognizing that we're hitting an inflection point and that scalability was going to be compromised without drawing in new outside financing. And so it was really those events that drove us, both the initial launch and now the scalability and hitting the J point or the inflection point of the curve that have driven our goals to go out and raise a round.
Twofold. I think you got to match the market, the external market, the public market cycle. So you got to see the timing's good. But also, I think the more important factor is you can clearly see how you're going to deploy it for business growth. I think that is the key decision in my mind. It's like, so if you're solving a particular problem where you got particular milestones, you go, okay, I'm there now, or I'm getting there, I've got all the proof points, now I need to raise capital so I can triple down, quadruple down on it. Yeah.